Hey everyone, welcome back to Retail Weekend Wrap Up. I'm Ray Kang, commercial real estate broker here in Texas. This is where we cover what is happening in the economy and the implications it has on strip center investment. Gas just hit $4 a gallon. Consumer confidence just posted its lowest reading since December, and the 10-year Treasury, the rate that was supposed to be coming down by now, just hit an 8-month high. So let's get into it. So let's start with the consumer, because the consumer is what drives foot traffic to your tenants. Friday, March 27th, the University of Michigan released its final March consumer sentiment reading. It came in at 53.3. That's down from 56.6 in February, and it's the lowest reading since December. Now, here's why that matters. This wasn't a gradual drift. The surveys taken before February 28th were actually showing improvement. Then the conflict with Iran started and everything reversed. What's really striking is who's feeling it. And we're not just talking about lower income households. Middle and higher income consumers showed some of the steepest drops. When your wealthiest customers are pulling back, that has implications all the way down to your tenant rent roll. Year-ahead inflation expectations jumped to 3.8%. The biggest monthly increase in about a year. Now, let's talk about why sentiment dropped so fast. According to AAA, the national average for a gallon of regular gasoline is sitting right around $3.98 today. That's up about 33% in a single month. And it's not just what people are paying at the pump. Diesel has gone up even faster, over 36% since the start of the conflict. Diesel powers the trucks that deliver goods to every store in your retail center. When diesel goes up, freight costs go up. When freight costs go up, retailers absorb it for a while and then it shows up in prices. Here's some more economic math put simply by the National Retail Federation's chief economist. U.S. households spend about $2,500 a year on gas, roughly $50 a week. If that number jumps by $10 or $15 per week, those numbers come out of somewhere. And where they come out first is restaurants, entertainment, and discretionary retail. That's exactly the tenant mix in most neighborhood strip centers. There was also supposed to be a tailwind this spring, larger than usual tax refunds from last year's Working Families Tax Cut Act. Oxford Economics estimated that if gas averages around $3.60 a gallon a year, that refund boost would be almost exactly offset. We're already past $3.60. That tailwind may be gone. Now let's look at the other side of this, because the picture isn't completely dark. Last week, the National Retail Federation released its 2026 retail sales forecast. They're projecting 4.4% growth over 2025. That would put total retail sales at $5.6 trillion. That's the highest growth forecast they've issued since 2022. The foundation they're pointing to is real wage growth, household balance sheets, and a labor market that, while softening, still has unemployment projected to stay below 4.5%. But here's also an honest read on the forecast. The NRF explicitly carved out the Iran conflict and said the repercussions were too uncertain to incorporate. So that 4.4% is the picture before the $4 gas. It's conditional. The other thing worth noting, and this is very relevant to your tenant mix strategy, is who's driving that growth. The NRF confirmed that the spending outlook is bifurcated. Common subject that we've been talking about. Higher income households are driving the majority of growth. Lower income households are feeling the pressure. That split matters enormously depending on what your tenant lineup looks like and what trade area you are in. Now, here's that trend I think is genuinely important for strip center owners. Dollar stores, which have historically served lower income households and are now attracting shoppers from every income bracket. Grocery Dive reported this week that dollar store executives have been calling out consistent gains with higher income customers for several quarters running. Dollar Tree specifically noted that its value proposition is attracting consumers across income groups and that the Iran conflict's impact on gas prices is likely to accelerate that trend. Dollar General's Q4 numbers back this up structurally. Same store sales up 4.3%, traffic up 2.6%, and their rotating $1 price point selection was up over 17% in comparable sales. That's not a struggling retailer. That's a retailer who's positioned exactly where the consumer is right now. All right, now let's connect all of this to what it actually means for the value of your property. The 10-year Treasury yield closed at 4.44% on Friday. That's the highest it's been since July of last year. And just 4 weeks ago, markets were pricing in 2 Fed rate cuts for 2026. Today, the markets are pricing in nearly a 50% chance of a rate hike by December. That's a complete reversal in 1 month. The driver is the same as everything else we've talked about today. The Iran conflict pushing up oil prices, oil pushing inflation expectations up. And now the Fed, which was easing, is being forced to hold or potentially move the other direction. So here's the direct line to your property value. The 10-year Treasury matters to strip center owners because commercial real estate lenders price loans off of it. When the 10-year moves, lending rates move with it, and it's the borrowing rate that determines whether a deal pencils for a buyer. Lenders on commercial real estate deals typically price loans at a spread above the 10-year, generally 150 to 250 basis points, depending on the lender, the deal, and the borrower profile. So with the 10-year sitting at 4.44% today, buyers in our market are looking at loan rates in roughly the 6 to 7% range. That's the real cost of capital on a strip center acquisition right now. So here's what that means in practice. A buyer underwriting a strip center is running debt coverage ratios and cash on cash returns. When their loan rate moves from 6 to 7%, the deal math changes. Either the price has to come down or the deal doesn't close. That is the direct mechanism by which a rising 10-year translates to downward price pressure on your property. A month ago, buyers were underwriting with an expectation that rates were coming down. That expectation has been replaced by the possibility of a rate hike. Deals that worked at one cost of capital doesn't work at another. That repricing doesn't happen overnight, but it accumulates and it shows up in the bids you receive when you go to market. So when the 10-year goes up instead of coming down, when the rate that refuses to fall keeps holding or moving higher, it puts upward pressure on cap rates. And higher cap rates mean lower property values, all else equal. Now, the counterbalance to that pressure is net operating income growth. If your rents are growing, if your occupancy is strong, if you're renewing leases at higher rates, that income growth can offset some or all of that cap rate pressure on value. That's why the story of which tenants are performing, value retail versus legacy retail, isn't just an interesting observation. It's directly connected to your property's income durability. To add to this, the US dollar is also sitting right around 100 on the DXY index, up about 5% from its February low. That's a safe haven move driven by the same conflict. A strong dollar matters less directly for retail real estate than the Treasury yield does, but it's another signal that the market is pricing in prolonged uncertainty. So, what does all this mean practically if you own a strip center? Three things to think about. Take a hard look at your tenant lineup. Which tenants are in categories that are holding up or growing right now? Value retail, essential services, food and beverage concepts that are performing. Which tenants are in categories that are softening when the consumer is under pressure? So, this environment tends to separate performing tenants from at-risk ones faster than a normal cycle. Second thing to think about is lease renewal timing. If you have leases coming up in the next 12 to 24 months, you're working in a rate environment that is not coming down as fast as anyone expected. Your NOI growth is one of the best defenses you have against cap rate pressure on value. Renewing at market or above market and locking in terms matters right now. And disposition timing. If you've been thinking about selling either this year or in the coming years, the rate picture we talked about today is something you need to factor into your analysis. The window where the 10-year was drifting toward 3.5% and cap rate compression was a realistic tailwind, well, that window might not be open right now. The question is how long this environment persists and what your personal hold period and equity objectives look like. And that's the retail weekend wrap up for the week of March 27th, 2026. The consumer is under pressure. Gas is near $4 a gallon. The 10-year is at an 8-month high. The National Retail Federation still sees growth, but that forecast was built before the conflict reshaped the picture. And value retail is pulling in customers from every income bracket while legacy formats keep contracting. If you have any questions or comments, please feel free to reach out. You can find my contact information in the description, and I look forward to catching up with you next week. Thanks.